Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cssc, Hong Kong Shipping Company Limited, Annual Report. Cssc, Hong Kong Shipping Company Limited, offers a diverse range of businesses and services to cater to the needs of its clients. At the core of its operations are leasing services, which provide tailored vessel leasing options through finance and operating leases. In addition to leasing, the company also provides shipbroking services, including recommendation and advisory services for vessel purchasers and charterers. This service enables clients to navigate the complex process of buying or chartering vessels with confidence. The company's financial services include loan borrowings, which comprise pre-delivery loans, secured loans, and factoring services. These services provide clients with access to capital at various stages of their business operations. Furthermore, Cssc, Hong Kong Shipping Company Limited, is involved in marine engineering and marine equipment leasing services. This allows the company to offer a comprehensive range of solutions for its clients' vessel-related needs. The company also engages in entrusted loan services, loan borrowing, and bond issuing activities. These services demonstrate the company's commitment to providing a wide range of financial solutions to its clients. Overall, Cssc, Hong Kong Shipping Company Limited has established itself as a leading provider of shipping-related services, with a diverse portfolio that caters to the needs of vessel owners, charterers, and other stakeholders in the industry. Cssc, Hong Kong Shipping Company Limited market capitalization of $15 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Cssc, Hong Kong Shipping Company Limited, holds a significant advantage in their industry. Cssc, Hong Kong Shipping Company Limited trades at a lower price-to-earnings ratio of 8 times and a higher price-to-book ratio of 1.03 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The leverage on the balance sheet appears elevated, with liabilities of 67% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 6.02%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth and decline for a shipping company can be identified from the extracted summaries. Revenue growth is primarily driven by an increase in shipbroking services, finance lease services, loan borrowing services, and operating lease services. The addition of new container vessels to the fleet also contributed significantly to revenue growth. Commission income from shipbuilding transactions and integrated shipping services revenue further boosted earnings. On the other hand, a decline in operating lease services, shipbroking services, financing services, and finance lease income led to a decrease in revenue. The company's revenue growth was largely driven by its expansion into new areas such as shipbroking and finance lease services. The addition of new vessels to the fleet also contributed significantly to revenue growth. However, the decline in operating lease services and shipbroking services had a negative impact on revenue. The company's financing services also declined due to a decrease in loan and lease receivables balance. Overall, the primary drivers of revenue growth were an increase in various shipping services, while the decline in these same services led to a decrease in revenue. The financial performance of a company underwent significant changes between 2 specified periods. Initially, net income was not disclosed in the earlier period, but by 2025, it had increased by 38%. This substantial growth indicates a positive trend in the company's revenue and profitability. In contrast, profit margins experienced a decline from 53.4% to 49% over the same period. The decrease in profit margins suggests that while the company's net income improved, its ability to maintain profitability relative to sales decreased. The company's ability to generate positive operating cash flow has been inconsistent over the years. In 2024 and 2025, the company was able to produce a positive operating cash flow, indicating that it had sufficient funds to cover its operational expenses. However, in 2023, there is limited information available on operating cash flow, but what is provided shows a negative total operating cash flow of HK $605,367. Furthermore, for the years 2021 and 2022, no explicit information on operating cash flow was given, although operating profit was mentioned. This mixed performance suggests that the company's ability to generate positive operating cash flow is not consistent across all periods. The company's debt level has undergone significant fluctuations over the past year. Initially, total liabilities decreased by 5.3% from HK $29,622,959 to HK $28,058,968. However, this trend was not consistent throughout the year. While some pages reported a decrease in debt levels, others showed an increase or no significant change. Notably, page 41 stated that total debt has increased from HK $13.4 billion to HK $11.5 billion, while page 105 reported a decrease from HK $29.6 billion to HK $28.5 billion. Additionally, page 185 mentioned that total debt increased significantly in 2025. In terms of interest expenses, the company experienced a significant reduction. Interest expenses decreased by HK $151.7 million to HK $795.9 million, and finance costs and bank charges decreased by 24% to HK $795.9 million. The average cost of interest-bearing liabilities also decreased from 3.5% to 2.9%. However, page 170 reported a slight increase in interest expenses. Overall, the company's debt level has been inconsistent, with both increases and decreases reported throughout the year. Interest expenses have generally decreased, but there are some exceptions. Management is optimistic about the company's outlook, citing several key factors that will drive its success. Firstly, the industry's profitability will remain healthy due to effective capacity management and route optimization. The company is well positioned to take advantage of the industry's green transformation, with a focus on clean energy vessels and alternative fuel ships. The shipbuilding market is expected to remain at a high level, driven by hard constraints on global capacity and demand for environmentally friendly vessels. This will lead to long-term market premiums for leading shipyards with green technology advantages, enhancing industry concentration. China's shipbuilding industry is poised to make a significant leap from scale leadership to technology leadership in the next 5 years. The company plans to leverage its parent group's industrial strengths to achieve high-quality development and build a solid moat for growth. This strategic approach will enable the company to capitalize on emerging trends and maintain its competitive edge in the industry. Overall, management is confident that the company is poised for success, driven by its commitment to innovation, sustainability, and strategic partnerships. The company has a history of paying dividends to its shareholders, demonstrating its commitment to distributing profits and rewarding investors. According to the detailed breakdown provided on page 28, the company has paid out a total of HK $0.16 per share in annual dividend payouts. This includes both interim and final dividends, as well as a special dividend payment. The specific amounts for each type of dividend are as follows: HK $0.05 per share for the interim dividend, HK $0.05 per share for the final dividend, and HK $0.06 per share for the special dividend. The current state of global supply chains is marred by significant concerns regarding disruption. Geopolitical conflicts have had a profound impact on shipping lanes, leading to sharp increases in freight rates, insurance premiums, and fuel costs. The ongoing disruptions have also driven the restructuring of global supply chains, with many companies reassessing their logistics networks. The Red Sea shipping route has been particularly affected, with container freight rates remaining elevated due to sustained e-commerce growth and intermittent port congestion. Furthermore, geopolitical events in the Middle East have contributed to supply chain disruption, causing delays in critical trade routes such as LNG and LPG. These short-term constraints are expected to persist, posing significant challenges for businesses reliant on these supply chains. In contrast, there are no concerns about inventory buildup, suggesting that companies are managing their stock levels effectively despite the disruptions. This is a testament to the adaptability of global supply chains in the face of adversity. That concludes the financial summary for Cssc, Hong Kong Shipping Company Limited. Feel free to comment below, and I will be happy to answer them when possible.